Why would you ever convert your IRA to a Roth? Hi, I'm Doug Ray, President and founder of the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to cover all things Roths and IRAs, tax benefits of both, how they differ from pensions and 457s, contribution limits and requirements, conversion limits and requirements, RMDs, and all things in between. Now, in this episode, that's what we're going to cover. Don't forget to hit the like and subscribe button there, and let's go ahead and get to it. Doug, what's the first thing we've got on this list?
Well, Brice, what are the tax benefits of an IRA?
So an IRA, an individual retirement agreement, not an individual retirement account like everyone thinks it is. Or was it arrangement? Arrangement, maybe.
It doesn't matter.
It's not account, but anyway, you call it an individual retirement account. The tax benefits of that are whatever you contribute to an IRA in that tax year, you get to deduct from your earned income. So let's say that you made $100,000 that year and you contribute $7,000 to an IRA. You get to deduct that $7,000 from the $100,000 of your earned income, which means you only owe taxes on $93,000. In a nutshell.
Yep. And the earnings inside that IRA are going to grow tax deferred.
Tax deferred, which means unlike a non-qualified or what some people call a brokerage account, every time you sell the holdings inside that, you have to pay taxes on the gains, short-term or long-term capital gains on the sell there. In an IRA, you can buy and sell inside that IRA all day long, all week long. You don't have to pay the taxes on those until you're actually taking a distribution from the IRA. So that's the tax benefits of an IRA.
So given all that, then what's the tax benefits of a Roth IRA?
Right. So we're talking basically a short-term plan versus a long-term plan. The contributing to an IRA in that tax year, that's your tax benefit in that year alone. If you contribute to a Roth, it is not a tax benefit. So again, you make $100,000 and you contribute $7,000 to a Roth, you do not get to take a tax deduction of that $7,000. Your earned income is still $100,000. Having said that, it grows tax-free forevermore. So let's say that you're 30 years old and you're not touching that Roth contribution for another 35 years. That $7,000 grew to $20,000. You get to take that $20,000 out as long as you're 59 and a half or older at that point, and you don't have to pay taxes on the additional $13,000 growth. So it's, as you say, Doug, would you rather pay taxes on the seed or the harvest? Well, via a Roth, you're paying taxes on the seed, and the harvest is coming to you tax-free.
All right, so Brice, given all that, then what is, and how are they different between somebody's 401k or their 403B or TSP or 457 plans?
And all those on pensions even as well. So all of those plans are still, they're structured like an IRA in that they are pre-taxed benefits. So you put pre-tax money in and you don't have to pay taxes on it until you get the money out. However, all those account registrations, Doug, that you just listed, those are employer-sponsored plans. So an IRA or a Roth is just you going to your bank or going to whatever custodian you want to go to and opening up one on your own and making that contribution on your own. 401ks, 457s, all of those are employer-sponsored plans, which means the contribution limits, which we'll talk about in a few minutes, are much higher than an IRA or a Roth contribution limit. And additionally, your employer generally gets to make a contribution to that, not just your contribution, but an employer match as well. That does not apply to an IRA or a Roth. Only you can make the contributions to those, you or your spouse, technically speaking.
All right, so let's go on from there. Let's talk about simples and SEP
Okay,
IRAs.
so I've got to look at the paper for this one. A simple IRA stands for Saving Incentive Match Plan for Employees.
That's a mouthful.
Both of these, simple and SEP plans, and SEP plans stand for Simplified Employer Pension Plan, though I've always called it Self-Employed Person Plan. Those are like IRAs, the contribution limits are different, and it allows a small business owner or somebody who is self-employed to make a contribution because they don't have a 401k available to them. They're able to make larger contributions to their own retirement plan, larger than they would be able to make contributions if they just had an IRA or a Roth.
Okay. Right.
A simple plan would be if you have employees. I'm speaking in very broad terms here. You'd have to talk to your accountant on which one you should open. But a simple plan would be if you have employees, you want to make contributions to them as well. A SEP IRA is basically if you're just a self-employed person and you want to make contributions to your account and your account only.
Yeah, one thing about a SEP, though, is if you are a business owner and you want to establish one for yourself, you must establish one for each of your employees as well.
That is correct.
And make contributions to those accounts.
You can't, if you have employees, you can't just make it to yourself and kind of leave your employees high and dry. There are rules around that, which we're not going to go into in this.
Yeah. So speaking of contributions, let's talk about that for these accounts.
Okay, so contribution limits, again, I got to look at my sheet here because they're always changing. In a SEP IRA, we'll tackle that one first. In broad speaking terms, again, you want to check with your CPA or your accountant on this, but it's generally $66,000 is the maximum you can contribute to that, or 25% of your earned income through your self-employment. However, there are a few caveats to that, and those numbers change generally every year. So that's the contribution limit for a SEP. An IRA and a Roth, we got to break it down into two different types.
Yep.
If you are under 50, the contribution limit to an IRA and or a Roth is $6,500 now in 2023. That changed from 2022, and they usually adjust it every year or every couple of years. But if you are over 50, the contribution limit is $7,500. Last year it was $7,000, so they just increased it now. Having said that, you can't contribute fully to both, but you can contribute a portion of that $7,000 or $6,500, whatever the amount is for your age. You can contribute, you can divide that up. You could contribute $3,500 to one and $4,000 to the other if you wanted. Generally, people want to go all in on one or the other.
Yeah. We'll
talk about why you normally would want to do that, but you're not obligated to do that. You can split it up. But basically, that's the contribution limit. $6,500 if you're under 50, $7,500 if you're over 50 for 2023.
They couldn't make it any easier, could they?
They sure don't. They don't.
All right, let's talk about conversion limits and requirements.
So conversion, this is where it gets tricky. A lot of our clients get confused by the difference between a contribution and a conversion.
Well, it sounds similar.
A contribution is you taking money out of your checking account or your savings account and putting it into an IRA for the first time or a Roth for the first time. A conversion is you taking money from your IRA and moving it to a Roth account. Now, that's a taxable event. We're going to talk a little bit further about this. But there are cases, particularly the closer you get to retirement or once you're in retirement, it makes sense to do a conversion and move some of that IRA money to a Roth account. That's what a conversion is. Now, we talked about the contribution limits. Conversions are different. There actually is no conversion limit to moving money from an IRA or a Roth. Having said that, you want to be careful because let's say that you had $100,000 in your IRA and you decided, I think I'm just going to convert it all to a Roth and never have to pay taxes on it again. Bear in mind that that just means you added $100,000 to your earned income for that calendar year. That probably takes you up from the 12% tax bracket into the 36% tax bracket if you do that. So you got to be very careful. Again, talk to an accountant or better yet, talk to your financial advisor on, is this a good year for me to do an IRA to Roth conversion and how much should I do?
Well, Brice, that leads me to a question. If a person can contribute to a Roth or an IRA or a combination of the two, what should they do?
Well, that's the million-dollar question for us financial planners. We get that a lot. A lot of times we haven't talked about this yet, but people will have who are working have Roth options in their 401ks. So generally we said 401ks are pre-tax money. Well, there are such things as Roth 401ks out there. They're getting more popular. More and more employers are allow that option for you. And the question becomes, should I be contributing to an IRA or a Roth? This takes some financial planning. So we can't give you that advice here over a little video cast like this here on the Vault. But it is an important question for you to get an answer to, because this could make the difference of your nest egg being worth $500,000 at age 80 or $550,000 at the same age. So we want to do some planning. You've got to look ahead, and financial planners like us, Doug, have the software for our clients that we can look ahead and see what makes sense for them to do, not just this year, not just next year, but 5, even 10 years in the future. What should they be contributing to, and when should they be making those conversions, if at all?
Well, you said a moment ago that a conversion from an IRA to a Roth was a taxable event.
Yes.
Well, why would anybody want to do that? And then if they do, when should they make that conversion?
Okay, great question. And we get that one a lot as well. Why would you want to do that? If this is a taxable event, Brice and Doug, why would I take money out of my IRA, pay taxes on it just to move it into a Roth? That doesn't make sense. I don't want to pay taxes. I'm going to keep it in an IRA. Okay, you're thinking in the short term with that train of thought. You're thinking, what's best for me this year? Let's think about our nest egg 20 years down the road, when we're in retirement or at some point down the road. What makes sense for me in the big picture, not just this year? And when you take that into account, we have to make some assumptions on what tax laws will be, what tax bracket you're going to fall in a few years from now. When you retire, when do you file for Social Security? There's a lot of factors that go in there. But what makes sense for you now, if it's a tax burden for you now, it still might, in the long run, have paid off for you to bite the bullet now, pay Uncle Sam what you owe him. And down the road, that account is now forever tax-free. That Roth account that you moved your money to is now growing forever tax-free. And that could be a larger amount for you to take distributions from down the road than it would have been if you just always left it in an IRA.
Well, Brice, let's go ahead and wrap this video and talk about the required minimum distribution.
RMDs. So, in short, government wants its money. The IRS wants its money. When you've put money into an IRA, you've never paid taxes on that. Well, the government's nice enough to allow us to have IRAs and Roths, but at some point, the government wants its tax dollars. So they have devised this little rule called requirement minimum distribution. And that age used to be 70 and a half, and then it was 72. And now in 2023, they've moved that age to 73. And what that means is you are required to take a certain percentage based on your age out of your IRA and pay Uncle Sam his due taxes on it. The rest you can keep for yourself, and if you don't need the money, then you hate RMDs because maybe you had enough from your Social Security and your pensions that you were hoping to never touch your IRAs, but you gotta. And so you can take the excess that you've got after you paid Uncle Sam his taxes, and you can invest it again into a non-qualified account, but you cannot, we get this question a lot, that portion you cannot convert to a Roth. We get that question a lot. You say, well, can't I just take that money that the government says I owe and just move it over to a Roth? No. You can do another conversion during that same year if you wanted to, if you still have money in your IRA. But the portion that you just had to take an RMD out, that is forever no longer allowed to be in a Roth account. So that's what an RMD is. It's now at 73. What did I leave out?
I think you got it all.
Okay, so that is the difference between IRAs and Roths in a nutshell. One thing that we didn't cover that is very worth noting, if you're going to make a contribution to your IRA or your Roth, you have to have earned income of that amount. So if you're contributing $7,000 to an IRA or a Roth, you better have earned $7,000 or Uncle Sam's not going to like you to do that. If your spouse wants to contribute to her IRA or Roth or his IRA or Roth as well, and they're not working, as long as you made $14,000, you can contribute to yours and your spouse's as well. It's basically the IRS is looking at it as householded money is all that is. So that's another rule regulation on contributions to IRAs and Roths. So that's going to wrap it up. That's everything IRAs and Roths in a nutshell. Feel free to, again, to hit the like and subscribe buttons to catch all future episodes. And remember, the markets aren't going to wait for you. I'm Brice Payne.
And I'm Doug Ray.
And this has been The Vault.